Picture this, a young woman named Sophie, fresh out of college, lands her first job and decides to start investing. She's eager, she's ambitious, but she's also a bit lost in the world of finance. Stock tickers, bonds, ETFs, it's like learning a new language. But Sophie is undeterred. She dives in headfirst, studying, researching, and learning about the financial instruments that could pave her way to a secure future. As Sophie navigates the financial seas, she uncovers the mysteries of stock tickers, the differences between a share and a bond, and the advantages of ETFs in diversifying and minimizing risk. Her journey is marked by curiosity, dedication, and a thirst for knowledge that fuels her every step of the way. Sophie's story is not unique. Understanding financial instruments can open doors to wealth creation. Today we break down stocks, bonds, and ETFs. Sophie's first step was to understand stocks. So, what are stocks? Let's break it down. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. This ownership stake is also known as equity. Now, why would someone want to own a piece of a company? Well, there are two main ways to profit from owning stocks: dividends and capital gains. Dividends are a portion of a company's earnings that are paid out to shareholders. Not all companies pay dividends, but those that do provide a steady income stream to their shareholders. Capital gains, on the other hand, occur when you sell a stock for more than you bought it for. For example, if Sophie bought a stock for $50 and sold it for $75, she'd have a capital gain of $25. But how do you know which stock corresponds to which company? That's where tickers come in. A ticker is a unique series of letters representing a particular stock. For instance, the ticker for Apple is AAPL, while Microsoft's ticker is MSFT. Tickers are used to trade stocks and track stock prices. If Sophie wanted to buy stocks of Apple, she'd look up the ticker AAPL on her trading platform. Similarly, if she wanted to see how Microsoft stocks were performing, she'd search for the ticker MSFT. Sophie quickly realized that investing in stocks could be a powerful way to grow her wealth, but she also knew that she needed to understand more. Scene script. Sophie then turned her attention to bonds. She wanted to know how they differed from stocks. Let's follow Sophie on her journey to understanding bonds. Bonds, unlike stocks, are fixed income securities. When you buy a bond, you're essentially lending money to an entity, like a corporation or a government. This entity promises to pay you back the full loan amount, also known as the bond's face value, on a specific date, called the bond's maturity date. But that's not all. The entity also agrees to pay you interest on the money you've lent them. These interest payments, often referred to as coupon payments, are usually made twice a year. It's like being a bank, lending out money and earning interest on it. So, how do bonds differ from stocks? When you buy a stock, you're buying a piece of ownership in a company. With bonds, you're not an owner, you're a lender. Stocks give you a claim on a company's future earnings and any dividends they might pay out. Bonds give you a claim on specific future cash flows, the interest payments and the repayment of the face value at maturity. And what about risks? Well, stocks and bonds each carry their own set of risks. With stocks, the risks are tied to the company's performance. If the company does well, the stock price might go up. But if the company's fortunes take a downturn, so might your stock's value. With bonds, the risks are slightly different. If the entity issuing the bond runs into financial trouble, they might not be able to make the interest payments or repay the face value at maturity. But generally, bonds are considered a safer bet than stocks because the income from bonds is typically more predictable. Sophie now had a better understanding of stocks and bonds, but she wondered if there was a way to diversify her investments. Sophie's research led her to ETFs. She found out that ETFs could be her ticket to diversification. So what exactly are ETFs? ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product, traded on stock exchanges just like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset. For instance, an ETF might aim to track the S&P 500 index or a specific sector like technology or healthcare. ETFs are composed of multiple assets, which can include stocks, bonds, commodities, or a mix. Now, how does this lead to diversification? Well, when you invest in an ETF, you're not just buying a single stock or bond, but a basket of them. This means instead of putting all your eggs in one basket, you're spreading them out. If one company or sector takes a hit, the impact on your overall portfolio is minimized because your investment is spread across many different areas. This strategy of spreading investments to minimize risk is called diversification. It's like a safety net, reducing the potential damage from any single underperforming investment. So, with ETFs, you can get exposure to a wide range of assets without having to buy each one individually. This makes them a convenient and cost-effective way to diversify your portfolio. Sophie now had a basic understanding of stocks, bonds, and ETFs. She felt empowered and ready to start her investment journey. Sophie's story is a testament to the power of financial literacy. We've journeyed from understanding the ABCs of stocks, the relative safety of bonds, and the diversification offered by ETFs. These are key financial instruments that, when understood well, can become powerful tools in your investment toolbox. The world of trading can be complex, but by breaking down these elements, we hope to have made it a bit more accessible. Like Sophie, we hope you feel more confident about your understanding of these financial instruments. Remember, the journey to financial freedom starts with knowledge.